We are live.
Welcome to Better Credit, Better Home. Your source for the latest local and national news that can impact you if you are in the market for real estate. Here are your hosts, the Kingwood mortgage guy, Mike Durr, who uses his 25 years as a mortgage professional to help people improve their credit, and Joe Salas, an accomplished home inspector, real estate agent, and trainer of new agents for Byrd Property International. Together, they will help you understand what you need to know to get the most out of your real estate investment. Let's get started.
Let's get started.
Let's do it, Mike.
All right. We're going to get that puppy out of here. Get that out. Yes, we are. So, Joe, what's going on, brother? Good to see you today.
Good to see you, my man. Good to see you. Just staying busy. Last week I had 22 hours dedicated to training agents in real estate. So,
oh my gosh.
Been busy this week, just about the same.
Yeah, I bet they don't ever call you for questions either, do they?
No, that's what I'm here for.
Yeah. Well, that's good. Well, one of these days we're going to have some people that are going to log in and watch while we're going, and they're going to ask you some questions too. And I was thinking that that's one of the things that we probably need to do at some point in time is set up. I know I've talked about it before, but we ought to set up a first-time homebuyers seminar. The information that I put on this today is pretty consistent with what might be information that I think that a lot of people would like to know. But the real key is just putting it live, setting up a time and a date and getting people to just show up and see what kind of registrations. I did one with a young lady down in the southern part of town, and I think we had 15 or 20 people on, and she did a good job. So anyway, but other than that, here we are. What is it, February the 7th? The market, I just share with you before we get started, is everything was looking really rosy until last Friday when the jobs report came out. And the jobs report came out and it blew the forecast out of the water. And it said that there were over 500,000 jobs that had been created in December. Well, the guy that I watch says that this is basically smoke and mirrors. They made some adjustments. They made all kinds of quirky things. And he said the real jobs report should have been somewhere between 80 and 100,000, which would have been below the forecast, which was 180. Well, when that happened, interest rates blew up. And even after the Fed spoke on Thursday, the jobs report indicated that inflation maybe hasn't slowed like it should, even though this report is supposedly bogus. And anyway, it's been a fight ever since. Rates weren't very good yesterday, and they're not as good as they were today. Now, don't get me wrong. I still believe what my guy is telling me, that rates are going to go down. This is a little bit of a hiccup, though. So that's one of the things that's happening. But other than that, the presentation today, I think, is very relevant to the people that we want to communicate with, and that's first-time homebuyers. So, did you get a chance to look at it?
No, sir. I've been wrapped up. Tuesdays are one of my busier days.
Well, yeah, and I'm sure that. Okay, well, this is it. Tim King might be our guest. Tim King's a local appraiser that I've been friends with for a long time. I always like to invite him just because we've got a mortgage guy, we got a realtor, we got an inspector, and we got an appraiser if we needed him. So he might just show up during the show. All right, this is what we're going to cover today. And the first one is humor, and the humor didn't make it today. So
that's funny in and of itself, Mike. Come on.
It's kind of sad, I know, but the humor was left out for whatever reason. So what we're going to do is we're going to move on to the 3 biggest challenges. And then the first is saving for a down payment and closing costs. That's one of the big challenges, but we're going to talk about ways to reduce cost. The second of the biggest challenges is finding a home you can afford. And that has really just recently, this last year, become a problem. But we're going to let Joe share with us, and we're talking about adjusting your home parameters. I mean, trying to figure out what you should do or what you should be doing at this time. The next one is having qualifying credit scores. And of course, an answer to that one is we're going to show you some ways to improve your credit score. So I think that's going to be good information. Hopefully, well, what I hope happens is that you don't have all three of the biggest challenges, that you might have one of them and we might be able to resolve one. If you have two of them, we might be able to resolve two. If we have all three of the biggest challenges, then you may be waiting a little while before you're going to be buying a house. So that's kind of what I'm talking about here. So here they are: saving for a down payment and closing cost, finding a home you can afford, and having a qualifying credit. Now, Joe, before I go on, can you think of any that I might have missed? I mean, I know there's other challenges, but I seem to think that these were the main ones. But what did I miss?
I hear a lot from, and I think it's a combination of everything, but a lot of times buyers are like, they say it's not the right time. And to me, it kind of relates to having kids. It's never the right time really to have kids, but home buying is like that to a sense, where it's never going to be the right time per se. There's always going to be something where you can use it as an excuse against it. But the longer you wait, potential is that the more equity and that you lose out on over time.
Yeah, I think that the problem with it's not the right time, and I get it. If you have one of these challenges, or if you have any challenges, it may not be the right time. But the problem is it's going to cost you. I mean, there's a penalty in the real estate world, because you don't come back a year and a half later and say, now's the time to buy. I can get it cheaper. Or you might have more money, but the home's usually going to cost more.
A little bit more.
So that's one of those things. But anyway, so these three challenges, we're going to talk about them. We're going to try to resolve some of these with some answers. So strategies to reduce the closing costs. So the first challenge was the money that it cost. And here was my version of solving some of these problems. And these could be pretty good tips for you to write down if you wanted to. Not you, Joe, but anybody that's listening. Apply for a low down payment home loan. Now, there are home loans out there that for conventional as low as 3% or FHA as low as 3.5%. You also have other products that are zero down. So that would be one. Apply for the first time home buyer grant program. That's one. Get an inspection. I kind of threw that in, but that is, I think, the return on investment when you get an inspection is multiple fold. I mean, if it's not 2 or 3 to 1, I think I'd be lying. I'm sure you may have a comment about that.
Oh, I think any home inspector worth his weight is going to find at least what you paid him wrong with the house as far as corrections that need to be made. But that knowledge of what is in that report, that the inspector did his or her inspection and gave you that knowledge is powerful when it comes to negotiations during the contract process.
Perhaps one of the best returns on investments you can make. Negotiate with seller for closing costs. Obviously a good idea. The reason I moved these and I put the inspection first and then the negotiate with the seller, so that, that's not to say that you can't negotiate for the seller on the home and then go back after the inspection, but a lot of times it's good to do it all at one time. Here's one: get a gift from a family. Now, the ones that I put on here towards the end are the ones that I see happen the most often. And it's amazing how many families want their family members, I was going to say children, but it's usually their family members, to be in a house, be in a stable situation. So I think that's a really good one. Another one that a lot of people don't always think about is to close at the end of the month. You pay less daily interest. It's not big, but it saves you money by closing at the end of the month, which means that you don't pay as many daily interest dates on there.
Very good. Mike, for those who are listening, on the gifts from the family, I know there's a couple of rules or things that people should know about. Can you let us know a couple of things as far as accepting money into their accounts, or should they wait until after they start talking with you? Is there paperwork that needs to be filled out, etc.?
No, thank you for bringing that up. Yeah, when you get a gift from a family member, the rules are very specific, and you have to do it. I would suggest that anybody that's listening you don't transfer money at this point in time. It just creates a hassle, and if you do it the right way, it's a one-time thing. A lot of times we'll send the money directly to the title company is sometimes a better way to do it. There is a letter that has to be signed by the gifting siblings or family member that has to say that it's a gift and not a loan. It's a couple of those things. So I just suggest that if anybody's going to be doing that, just talk to somebody. Obviously, I'd like you to talk to me, but talk to somebody that knows how those things work. That's a great question.
Yeah, if I have anybody that is looking into that, I'm going to turn them right to Mike and say, talk with him. He's got all the rules and regulations.
Yeah, we pass those on to those guys. And I'll tell you, the gifting family member doesn't like it. They're not going to like it. So just be aware of that.
I've been through it.
Okay. So strategies for coming up with the down payment and closing cost. Well, I've used some. Actually, I like this picture here. This is a gal that's having a garage sale, and I used to have garage sales all the time, and I'm a fan of them, and it's amazing what people will pay for the junk that you've got in your garage. I mean, it's just crazy. But plan and save aggressively is one. Make a strict budget and stick to it. It's a big one. That's a Dave Ramsey thing. Borrow or use the money from your 401k. So you can use the money directly. It's called a hardship case when you do that. There are other ways that you can borrow the money and pay it back within 6 months and not have any kind of hit to it. So you want to investigate the options if you have a 401k. Ask family for a gift. We mentioned that one before. Sell something of value. I've had people that sold vehicles, motorcycles, all kinds of stuff, where they were able to get a pretty good chunk of money for either the down payment or the closing cost. And then here's one that a lot of people don't think about. Ask your lender for suggestions. Now, when I say that, the way that we price loans, sometimes we can give you a rate that has a premium. And this premium can go towards paying your closing cost. It can't pay for down payment, but it can pay for your closing cost. And I mean, that can be substantial. So we've done that on a lot of them.
That's pretty cool.
Yeah. You think of any that I didn't list on there?
No, I think you summed it up pretty good. I love garage sales as well.
Yeah. I mean, garage sales are cool, not only to have, but to go to. You see some crazy stuff.
Find some neat stuff there.
All right, I thought I'd flick that. There we go. Here we go. This is your slide. Finding a home you can afford. Well, one, you want to get with a mortgage professional and find out what you can afford.
You can't afford.
Get with your realtor too. See what's out there. Know what you can afford. Know your credit score. Gather your financial documents. Explain to realtor what you want and explain to the realtor where you want to live. And let's see if it's reasonable.
The most important step is contacting you, figuring out where they can be as far as the home price.
And a lot of people, this is kind of interesting, Joe, is a lot of people they think that I'm qualified to buy a X $100,000 house, right? But it's not that. What we look for, what we qualify you for, and you may not have thought of this, is we qualify you for what your payment can be the highest of. And here's the reason I say that is that a lot of time when you say you're qualified to buy a $400,000 house, that's assuming that the taxes and the insurance are consistent with what I estimated.
Correct.
But in some cases, the taxes are way high or way low, mostly high, and you got a fuzzy number there. So what I like to do is I like to say, here's a range, but this is your number. And this, when you're out there shopping for properties, I want you looking and see what the taxes are. And I can give you a pretty rough estimate of what the insurance might cost, but dude, you got to know the taxes. And
I love your worksheet that you do to work up the estimates. Those are really cool, Mike.
Yeah, I thank you for that. I wish I could tell you I created it. I kind of stole it from a past lender that I worked with, but I've used it forever. And it's just one of those things that it tells you all the things you need to know, and it's pretty darn accurate. So
it's a great tool. It's a great tool for any buyer out there.
Well, then there's not the things that they print out of most of the loan software that we have is not very understandable. It's not
No,
simple to
sorry.
understand, where that's pretty simple. I like to do the videos with it to make it a little more simple. All right, adjusting your home parameters. So just be ready for this. Is you may need to buy a smaller home. You may need to move a little further out. You may not get all the features you desired. The home may need some fixing up. You may have to make some compromises. Is that some truth there?
Amen. Yep. You preach, Mike, for sure, because that's exactly what we've been coming up against in the last, I would say, about 7-8 months, when the interest rates raised.
Yep.
Is it took a lot of people out of the market where they wanted to be in, and it put them into a market where the homes were smaller, the lots were smaller, the features and amenities and fixtures, either in the neighborhood or the house, were different. And a lot of the buyers pulled back a little bit because they had their minds and hearts set at a certain level.
Yep.
And then when the rates raised, it took them out of that level and put them into a different level. So that's what we've seen over the last few months.
The rates, actually, you say that, I saw a number where when rates were at their highest in the 7% range, and they're not there now, by the way, but when they were, that was about adding, for a $300,000 or $400,000 house, about $600 a month to the payment. And I'd say that number now is closer to $450 something. And,
Yep.
and you know, and I'm an optimist. I say this over and over again. The rates are coming down. I think they will, even though it wasn't today. So let's see. I'm thinking, what is the degree of a fixer-upper that people can get? I'm asking you this, is what you see makes sense for people to buy and they'll still go through a conventional loan.
You are able to do the painting the walls and replacing flooring, etc. And this would be a great opportunity for Tim to speak up if he was joining us today. But a lot of times there are certain guidelines and parameters that appraisers work to in what they do in providing their opinion of appraised value. And I've been in a couple of situations where the appraiser came back on a quote unquote fixer upper and said, hey, I will give you this value of appraised value for the house, but these things have to happen in order to get to that point. So that is something that I'd caution any buyer out there, especially first time home buyer buying a fixer upper. Let's make sure you know everything that you're getting yourself into. And one of them is just, where is that information as far as the appraised value versus what you're loaning and what you can afford afterwards, and do you have a plan approaching it? And that's a little bit beyond the scope of what I do in real estate, but I'm friendly enough to say, hey, I care about you. Do you know what's going on after you buy this property, and are you prepared for that, right?
Yeah, so the term is, on the appraisal, it says subject to.
Yes.
This appraisal is valued at, subject to these repairs being done, and they'll be very specific into the repairs that they require. And in most cases, they're by their rules. I don't know what the term is, but the rules that they go to govern the appraisals, they have these specific rules that means you have to repair certain things. Tim, sorry we missed you on that one. We kind of winged it.
Next week, man.
Okay. So you need to have qualifying credit scores. Well, this is one of the things that it's kind of my specialty, but the qualifying credit scores are different for each different loan type. Conventional minimum is 620. That's pretty hard and fast. If you're 619, you need to get to 620. That's just the way it works. On FHA, the FHA minimum is 580 for 3.5% down, but they'll go to 550 if you put 10% down. But that 580 is rock solid, and if it's 579, you're not going to get a 3.5% deal down. VA has no minimum credit score. I mean, they look at the credit as a whole, and if it's horrible, they just won't give you a loan. But if you're close, or if you're trying hard, they'll give you the benefit of the doubt. And VA has very underwriting centric, so they don't say you got to have this to get that. Most people, we look at it as more 600 or above, kind of like the FHA. USDA minimum is the standard is 640, but there are lenders out there doing them right now that are 620. The USDA minimum is important because that is a zero down loan. It is superior in rates and mortgage insurance to an FHA loan. And the only negative thing about that is you can't buy a USDA home in a suburban area. I say that in some counties you can. It just depends on what the county is. But when you qualify for a USDA home, they want to know how much money you make, and then they also want to know where the property is.
Right.
And either one of those two things can kick you out of that. But
Yeah.
one thing that I encourage people to do, because it's zero down, is we ought to try it. So that's one of the good things to look at.
And if you have a question as far as where the property is and in relationship to whether or not the house is available to be used, that the USDA loan is able to be used on that house, give me a call. Or I think, Mike, you do actually have access to that as well. Right?
Well, yeah, there's a website that you can go to that you can plug in the address of the property, and it'll tell you yes and no. And if you wanted to qualify yourself, you could do that also to see if you make too much money. And I forget exactly what the number is, but it has something to do with the medium income in that specific county. So finally on this, the jumbo loans, you got to have a 700 FICO score, and you probably should have a 700 FICO score if you're going to be doing a jumbo these days, because jumbos, what is the conventional loan limit these days is 800,000?
Yeah, isn't it 7 something? 700-800 somewhere around there, right?
Yeah, it's way up there. So it's I mean, unbelievable. You can buy a lot of house on a conventional loan these days. So all right, that should help there. Now, strategies to improve your credit score. Now we told you what the credit scores were that you need. So now we're going to tell you what you need to be doing. And the first thing I tell people is pretty simple. Pay your bills. Pay your bills on time. Pay them when they're due. That's kind of helpful. This is controversial, particularly if you're a Dave Ramsey fan like myself. I put on there, have a couple credit cards. And the reason I put that on there, and Dave Ramsey would just swat me upside the head if he heard me say it, but there are points given when you not only have a credit card, but particularly if you've treated it in the way that they like. And there are very specific ways that you handle a credit card that gains you points. And there are also ways that if you handle it the opposite way, it's going to cost you points. So that's a big deal. You need to know that. Not a lot of people seem to figure that out. So just be aware of that. All right. And call me. Keep the balance. Here's the part that kind of explains that. Keep the balances on the credit cards to no more, that's what it should say, to no more than 30% of the limit. So when you get a credit card, you get a limit that you can use on that credit card. Well, you got a balance, and that balance compared to the limit needs to be 30%. Let me give you an example. It's simple. If you have $1,000 limit on your credit card, you don't want to have anything more than $300 as the limit. That's 30% of what the $1,000 limit is. If it's below, you actually get the most number of points around 10%. So that's something that you can manipulate yourself to increase your credit score. We do that a lot of times. Take care of any negative credit reported. This could be past collections or charge-offs. They will cost you points. The collections don't affect you so much after 2 years. The charge-offs do. They continue hurting you. Pay down any outstanding debt. That doesn't mean pay it off. I've actually told a customer to go use his credit card and he would get points. So the credit card companies do not reward you for having a zero balance. Funny, but they don't make any money when you have a zero balance. They're not going to reward you for having a zero balance. So that's one of those crazy things is I tell people who have $10 or $15 balance on there, use it for $50 a month and then pay that 50 and just leave that $10 on there. The interest is not going to kill you.
Mike, somebody once told me that, and I don't know if this is true or not, so correct me if I'm wrong. But somebody once told me, if you have a mortgage currently, and if you've been late in the last 2 years, pretty much you're kind of disqualified for getting a new mortgage or refinancing or something like that. Is there some sort of rules?
There is
running
a 12-month rule. It's not 2 years. It's 12 months.
okay.
And so what they, and there are some, it's not an absolute rule, but underwriters don't want to see you being late on the mortgage. I mean,
Yeah.
that's just one of the things. They're making you a loan. They don't want to see you be late. And
Yeah.
that's why when you look at, I talk to people that have had some rough credit, and they're in the process of getting out of this trauma that they've had, but they still have some late payments. I'm saying, dude, it's not just your mortgage, it's anything. I mean,
Yeah.
anything that you're paying late, they don't want to see that. The one thing that the FHA does is they will applaud you and give you credit for getting out of a credit trauma, right? They're going to root for you, and they'll give you a loan. But if you're still fighting in it, they don't want you until you're out.
Yeah.
And so that's what that is all about. So yeah, 12, don't want to be late on the mortgage. That's a no-no for sure. The last one I've got on here is do not close any credit card accounts. The reason that we say that is even if you're not using those accounts, it reduces the amount of the capacity that you have for borrowing money, and the larger capacity and the less that you don't use, it's a good thing. If you close that capacity, then it makes your debt ratio scoring algorithm thing, whatever it is, how they figured out, they don't like it. So it's not a good thing for your credit score. One thing I didn't put on here that I answer this all the time is there is a rule or a statement from a lot of people, maybe a myth, that if you pull my credit, it will hurt my score. Have you heard that?
Yeah, we talked about that before. You said you can pull it once and then you can redo it for 60, 96 months. I don't know. What was that figure that you had?
So here's the way the rule works. And they did this because they don't want to keep you from shopping.
Right.
Okay. Now, I don't encourage people to go out and have their credit pulled by everybody in the world. But the way the rule says is after you get that first pull on your credit from a mortgage company, then you have 45 days.
45 days.
And you can have it pulled by 100 different companies if you wanted to. Now that is an over exaggeration, but within that 45-day time frame, it's not going to hurt you. They count that as one inquiry. So that's something I answer a lot, and I don't know if anybody believes me or not, but maybe it's written somewhere. Thanks. Yeah, I feel that was so much better because of that. All right, so find out how much your home is first. Find out how much your home is worth by calling Joe Salas, and he'll help you out. He's going to help you out. You can reach him at 346-224-4224. He'd love to help you. He will gather all the tools that HAR has for that. And tell me what that looks like. What do you do when you do that, Joe?
So I have a couple tools at my disposal. One of them is an automated tool. It kind of shows you what an algorithm runs and shows you what the value is. The other one is a more manual type exercise where I actually will go into the system, preferences to meet at your home, and look at the values that I've pulled from the system and compare it versus your home. Any updates, any improvements, all of those things would be taken into consideration at that time. And then I could give you a pretty solid range of where I think the value of your home would sit.
Good. Okay, good. Yeah, that's a good thing to do. It's smart to do that. That way you'll know what it is. All right. So unfortunately, the rates that are on here are not correct.
So, oh, you had my hopes up, man. What is it, worse or better?
It's worse. I can tell you what they are. The 30-year fixed rate for conventional today was 6%, so it's up an eighth.
Back in the sixes.
The 15-year was 5.25%, so it's up a quarter. Yeah. Now, on this, just a note on this difference between the 30 and the 15 is not normally 8 or 7/8 of a point. It's usually about a half point, so it's more in line with what it normally is. But and then the FHA was, what was it? It was, I think it was right at the same. It was 5.75 or 5.875 when I look. And that's for me being late. I got a little bit late, and I prepared the slide. I just didn't get it transferred over to the show today. But first off, Joe, thanks for being here today.
Thank you, Mike. Love it, man.
For people that are out there that are getting a chance to watch this, I sincerely appreciate you taking time. I encourage you to subscribe, share. We love that when you do that. And then also, if I'm starting to break this down and do some shorts, I'd love for you to get a chance to look at those also. But until next week, and this crazy world of real estate that we live in, hopefully we'll have a better report next week. All right. Thanks, Joe.
You're in, man. Bye.